The Capital Asset Pricing Model, CAPM, is a widely used model in finance that helps to determine the expected return on an investment, given the risk-free rate, the expected market return, and the asset's beta. The risk-free rate is the return on an investment with zero risk, such as a government bond. The expected market return is the expected return on the overall market. Beta measures the volatility of an investment in relation to the market as a whole. A beta of 1 indicates that the investment's price will move with the market, while a beta less than 1 means it is less volatile than the market, and a beta greater than 1 indicates higher volatility. The CAPM formula is the expected return equals the risk-free rate plus beta times the expected market return minus the risk-free rate. So the expected return on an investment equals the risk-free rate plus a risk premium, which is determined by the beta and the difference between the expected market return and the risk-free rate. An important assumption of CAPM is that investors are rational and risk-averse, and that they have access to all available information. Also, it's assumed that markets are efficient, and there are no transaction costs or taxes. CAPM can be used by investors to evaluate the potential return on an investment, as well as by companies to estimate the required rate of return for a project or investment. However, it's important to note that CAPM has its limitations, such as the assumption of a normal distribution of returns, which may not always be the case in reality. Also, it may not work well in markets that are not efficient, like emerging markets. Overall, the Capital Asset Pricing Model, CAPM, is a widely used model to determine the expected return on an investment, given the risk-free rate, the expected market return, and the asset's beta. However, it's important to understand its assumptions and limitations in order to properly interpret its results. Thanks for watching Finance in 2 Minutes, where we break down complex financial concepts into bite-sized chunks that are easy to digest. But before you go, don't forget to hit that subscribe button and join the club of people who know how to handle their money like a boss. Because let's be real, if you don't subscribe, you'll end up like the person who thought a subprime mortgage was a fancy sandwich. See you in our next video.